well. We are below the 21,400 mark. We've given up those gains as well and trading pretty much in the red. In fact, if you see the advanced decline ratio as well on Nifty 50, pretty much in favor of the bears. 30 declines versus 20 advances coming in there. In fact, 0.3% is the kind of cut that you're seeing in terms of Bank Nifty, and you have almost 150 points downtick coming in there. In terms of stocks, Adani Ports, Wipro, Hero Moto, Hindalco, as well as Adani Enterprises, these are the ones which are trading under pressure, seeing cuts in the range of almost 1.5% to 2% as we speak. Whereas if you see the ones which are absolutely strong is a Nestle, Tata Consumer, ITC, three FMCG counters which are now seeing some bit of buying interest that is coming in after a couple of days of selling that we saw. So strong moves on that one. Coal India is up in trade, as well as the Axis Bank, which is seeing gains of almost around 1.2%. Let's quickly pull up the PSU Bank Index as well and see what's happening on that front, as well as Bank Nifty components, because the breadth in terms of Bank Nifty as well is absolutely in favor of the bears. And you have the PSU Bank Index, which is seeing cuts of around 0.7%. So cuts in terms of the PSU banking space is much deeper as compared to the private banking space. You have Axis, IDFC, Federal, three counters which are in the green, but Bandhan is seeing some cuts. AU Bank, Bank of Baroda, PNB, as well as SBI. These are a few of the top losers. Let's pull up the mid cap as well as the small cap index as well and see what's happening on that front, because yesterday's session you did see outperformance coming in from the broader markets. Today you have the mid-cap 100, which is seeing cuts of almost around 0.4%. And if you pull up the small cap as well, pretty much on the flattish lines. Shipping companies are up and about in trade. GE Shipping, Shipping Corporation of India, SR Shipping, all of these counters seeing gains in today's trade. And this is on the back of the concerns we are seeing on the Suez Canal. Freight rates are expected to go up as well. Now, whether this will augur well for the shipping companies or not, we will tell you more in our 1 p.m. show as well, when we speak to experts about what is the Indian impact that we could be watching out for. But apart from these shipping companies, a lot of individual counters that are in focus in today's session. You talk about a Z Entertainment. That's one of the newsmakers that we have been watching out for. Let's pull up a Z Entertainment, down 2.5% to 3% in trade. Apart from this, a SpiceJet is an interesting one to watch out for. In fact, with a SpiceJet, let's pull up an Indigo and see what's the counter impact that we are seeing with the interest that they have shown with regards to Go First. SpiceJet seeing gains of around 3.4%, but let's pull up Indigo as well. Interglobe Aviation is seeing cuts of almost around 0.5% in trade. So that's with regards to few of the other movers and shakers, but Kiri Industries, 15% up move coming in today's session. India Glycols is up 7 to 8%. Vakrangi is another one which is seeing some smart gains. KPI Green is trading under pressure. LT Foods, Siemens continues the downtick, and this is after the company has announced details with regards to where demerging the energy business goes. Yesterday the stock was up in trade. Today seeing some bit of profit booking that does come in. So that's the overall market that we are looking at so far. But one company that is in focus is Webel Global. Let's pull up that counter on the screens and see what the stock is doing in trade. Clearly 0.3% higher in today's session. Now, this is a vertically integrated digital retailer of fashion jewelry and lifestyle products. In fact, the company has presence through proprietary TV channels and digital platforms. They've recently acquired Ideal World and Mindful Souls, and they're targeting a revenue mix of around 50% by FY27 of B2C revenues. To discuss more, Nitin Panwad, CFO of Webel Global, joins us now. Nitin, good morning and welcome to the show.
Good morning, and thanks for having me.
Always a pleasure. Nitin, overall, if you see in terms of retail as a business and the space that you are in, the last couple of moves that we've seen is you're driving it through acquisitions. What's the strategy looking like going forward?
Yeah, so apart from the acquisition, actually, our existing business, we are seeing past some quarters doing well. We have seen consistently improvement in our results in past some quarters. And also the operating leverage, because of our business model, we are improving our bottom line also. But the recent acquisitions there's a couple of reasons behind it. There's a rationale of the company we acquired, Ideal World, which is a well-established brand in UK, running business in the last 20 years. And I think the business-wide it was quite good. Number of customers they were serving was quite good. And the opportunity came to us, and with a decent amount of price, we got this company. Actually, brand actually we acquired, so we don't have any debt with this company. We got company's IP rights, company broadcasting rights, and studio and IT equipments. We got it, and we paid 1.125 million GBP, almost 11 and a half crore rupees. We paid this company, and perceived to gain the market share through that. Right now, currently, with what we monitor, we are almost around 10% market share in UK, and with that company, we'll continue to expand our market share.
Right.
And also the other company, Mindful Souls, which is more a D2C company, where this company sells products through own website in US, Europe, Australia, and Canada. And we got this opportunity. We have done the deal with 12 million euros. And the company has a really robust turnover of 18 million euros and grown very well in past 4 years. And obviously we are expanding our presence in digital space. So internally we are learning with our internal brands, each other with all synergies. But obviously always have a welcome from learning, which is a company who is doing well in this space. So we are expecting not only a good turnover and profitability, but also learning and synergies within our existing brands.
Right. So when you talk about top line and profitability as well, how is it looking like in terms of FY24 and 25? Because clearly we're expecting the top line to grow by around 13 to 15% and probably in high teens in FY25 and a good operating leverage. So is that something that you still maintain, or are you expecting something better than what what you had given out earlier?
Yeah. So the last quarter we have revised our guidance. And previously we have given 8 to 10% growth in this year. So we are keeping that our guidance. And the increased guidance of 13 to 15% for this financial year is purely for our new acquisitions. And we are keeping that our guidance, and we expect that to achieve those guidance. But for the next year also, we are keeping that guidance to grow high teen numbers. Grow in our existing business, and also helped by our new acquisition that we have done it.
So Nitin, just to clarify, you're saying 13 to 15% top line growth is only with regards to new acquisitions. But if you have to look at the existing business and the new acquisitions consolidated, what's the overall guidance that you have?
Yeah, so I meant for the overall guidance for this full financial year, 13 to 15% growth.
Okay, so that's in terms of the top line. Now, in terms of the recent acquisitions as well, you've mentioned about the synergies. With regards to the short-term margins, will they probably go lower in terms of the acquisitions, taking the integration into consideration? And will that have an impact?
Yeah, so the Mindful Souls is already having a good profit margins. Almost double-digit PBT margins they are generating, and we are expecting that this margin will continue to improve with our existing leverage on our supply chain and operational efficiencies. And ideal world, we are expecting that company to make break even within a year time frame. There's no major operational running cost with the business, so we don't expect that it will be a hard hit on our bottom line. We expect that we'll continue to gain our operating leverage and continue to deliver our profitable EBITDA margins.
Okay. Overall, if you see in terms of business as well, now the key aspect over here is the kind of growth that we've seen. Now, pricing as well as the vertically integrated business model is something which has been aiding your existing business model in terms of margins. In terms of the current revenue mix, you have around 29%, which still comes from B2C. And you're aiming that to become 50% by FY27. What is going to be the strategy, and how will this revenue mix towards B2C increase to 50%?
Yeah, so I think you mentioned B2C, but actually it was a digital, which I would say that our major business is B2C, B2B, we don't focus it, we just opportunity business. It's just more digital business that we are expanding. So digital, I mean to say that revenue which is coming from our own proprietary website, mobile apps, smart TV, and OTT apps. So which is currently trending around 30%, and our expansion strategy on OTT platforms and expansion on digital learnings. Through that, we are targeting to achieve 50% our digital revenue as a whole business to 50% by FY27.
Okay. And overall, if you see in terms of further acquisitions, what is on the cards? What regions will you be targeting? And how much are you looking to spend?
Yeah, so as of now, we are focusing more to establish those of the new acquisitions. Right now, there's nothing on the table to get. We are looking for the acquisitions. There will be a defocus if we go for more further acquisitions, but we are more looking towards the establishing those both of the acquisition, and after that we may look. But as of now, we are not looking for further acquisition at this moment.
Okay. And if you, I mean, in terms of growing the existing acquisitions, how much will they actually contribute to your revenues? If you have to talk about Ideal as well as Mindful Souls, currently what's the contribution to your overall and how much will they grow to?
Yeah. So in this year, full year, and in second half of the year after October, it will reflect in our revenues and profits. So that's why the additional revenue guidance that we have increased from 8 to 10 to 13 to 15. It is the all related to the new acquisition. The turnover, which was Ideal World previously having 60 million, we don't expect that turnover, as we have guided in our investor presentation, that we are targeting to achieve that turnover in next 3 to 5 years. Our target first target is to make it profitable, that business, because strategically we are changing the business model, which they were operating pretty low gross margins, 25 to 30% gross margin they were operating. But now as a help with the help of our supply chain, we are operating with 60% gross margin that business. So we don't expect that business to achieve that much turnover sooner, but we expecting that it will be a profit break even within 12 months.
Okay.
And the Mindful Souls, we are expecting that they have achieved 18 million euro last year, and it will continue to grow.
Okay, let's understand the B2C strategy in terms of the revenue format and product category. You've slowly reduced your TV revenues and digital revenues have been increasing. So correct me if I'm wrong, that is what is going to go to 50% currently in terms of digital revenues. And secondly, between jewelry and lifestyle, where are the margins higher and how is that revenue mix expected to pan out?
Yeah. So TV and digital, if I first talk about your first question, so both businesses are actually growing, but the growth rate on digital is much higher. So as the TAM is pretty high on digital space, so we expect that the digital business will grow faster. TV will grow, but not at the speed of digital. And the other question you talked about, the jewelry and lifestyle categories. So Ideal World was predominantly doing business in lifestyle categories. It was one of the key factor to grow our business on lifestyle products. But in terms of margins, the both of the categories has similar kind of margins, gross margins they are operating. Also, as a strategy, we don't operate or we don't procure the products which generates a lower gross margin than 60%. So both of the categories has a similar gross margins, and we'll continue to focus on to increase our gross margins above our guidance of above 60%.
Right, so that's the margin outlook as well that we're looking at. Thank you, Nitin, so much for joining us on the show and sharing your views. So that's the management of Webel Global. But let's quickly slip into a short break. Up next, we will speak to the management of Transformers and Rectifiers India on the other side. Please stay tuned to NDTV Profit. Welcome back. Now let's shift focus to transformers and rectifiers. The company's market share in the power and transformers division stood at about 22 to 25%, whereas the 3-year order book CAGR growth was at 15.2%. To discuss more in terms of business outlook and the trajectory going forward, Chanchal Rajora, CFO at the company, joins in. Chanchal, welcome to the show. Chanchal, my first question coming to you is, overall, if you see in terms of where business is concerned, one of the key concerns that we've been watching out for is the working capital gap due to Jetco. 120 crores is what you've raised due to preferential issue on private placement basis. This would somewhere ease your working capital concerns. How are you expecting the improvement to come about?
First of all, thank you for inviting me here. And yes, there was some concern about the working capital in the first half of this year, right? But after raising these funds of preferential order of 120 crore rupees, our working capital cycle has been quite eased up. We have utilized these funds to mobilize our resources in a proper manner. And what I can tell you is that right now our systems are in place to achieve what we are targeting for the year.
Right. So, Chanchal, are you expecting a reduction in the receivables then in the second half after, Jetco has now actually started to release the stall payments, and how do you see that helping you?
Yes, we do maintain it, and we are trying for that we will be able to achieve that in this half yearly. The 120 crore of infusion plus the Jetco started releasing the payment has basically not only strengthened my working capital cycle, but my raw material procurement has eased up, and that is helping us to achieve the targets what we have set up. And I can tell you that by end of this financial year, we will be able to achieve the last year targets.
Right, so 1,400 crore is the target that you're looking at in terms of top line. How much of the remainder outstanding of Jetco will come in FY24?
Jetco has started making the payments to us by the end of the October months, and a sizable amount of around 50 crore rupees has been received till now to us. And we expect that by the end of this financial year, the majority of the portion will come up into the picture.
Right. So along with the top line, the Jetco outstanding has actually put the margins under pressure as well. But now with things improving, can we expect the margins to remain in the same range as we saw in FY23?
If you see my quarter-to-quarter comparison from Q1 to Q2, you will see a substantial increase in the EBITDA level of the margins, which basically were under pressure because of the working capital constraints. If going forward on the H2, you will see that we will be able to maintain, but slightly better margins will achieve as compared to the last financial year.
Right, so margins will be maintained. What about the order book? Will it be same as FY23, or you will be able to surpass that CAGR growth?
If you see right now, the transmission and distribution CAGR is around 10 to 12% level, and the driving factor into this new business segment is also adding up the business in very, very fast manner, and that's the reason we will be able to achieve the growth levels what we are basically achieving.
Right, so you've always mentioned that exports is something which you're increasing. Exports will be margin accretive. So by how much will they improve your FY25 margin profile?
If you're talking about FY25 margins will be in mid-20s level, somewhere say not mid-20s, mid-teens level, which will be somewhere into the around 14 to 15% EBITDA margins levels. And this year margin was we will be achieving the margins of what last year we have done it. That's what we are thinking into it.
Right, and very lastly, what's your expansion strategy and capex plan looking like, Chanchal?
Company's strategy is very clear, basically. that we wanted to, we are not focusing right now top line much that. With the top line expansion, we are more focused on the bottom line. That how do we basically strengthen our bottom line and strengthen our systems in place. As you say, as a CFO and advisor, I basically work onto what we call as a CPIR basically mode. I am working to that, where I have to control. I have control on cash flow, my payables, my inventories, and my receivables. If these 4 points are under my control, my business growth is already there in place. As far as the capex is concerned, we are targeting a capex of around 50 crore rupees in next financial year, which will basically mainly for the IDT transformers and green hydrogen transformers. And that capex will give me additional revenue of around 500 crore rupees on a yearly basis.
Right, so that's going to be an interesting one. An additional 50 crores capex is what you're targeting as well. Thank you, Chanchal, so much for joining us on the show and sharing the views. The stock has actually more than doubled in the last 6 months as well. But moving to the primary markets, multi-format apparel retailers Kredo Brands, commonly known as Mufti, their marketing IPO, their IPO opens today. The issue price is at 266 to 280 rupees per share. My colleague Sajid Mangat had a chance to speak to the management of Kredo Brands. Let's listen into that conversation.
We have been in this business for the last 25 years now, and we've had a profitable journey along the history of the company, and the cash that the company has been generating is enough for the growth that we have been doing always. And over and above that, there is the cash which the company has also been paying as dividends to its shareholders. So whatever we've been doing is what we intend to continue doing in the future. We've opened 31 new stores this year, and we opened the first 6 months, and we opened 52 new stores last year, and we also paid out a dividend last year. So in spite of the stores that we opened, with the way that the business has been growing profitably, we are able to generate enough cash for the growth that we intend to do going forward as well. And we have some angel investors who've been with us for more than 16, 17 years now. So it's being done to provide them an exit, and also it will help the brand in terms of providing more visibility and doing more exposure to the brand, and that will be profitable for the brand as well.
It's going to be interesting to see how these IPOs stack up, because 12 IPOs in the mainstream and SME segment that are on board this week. But completely out of time. That's all that we have on the show for now. Stay tuned for more news and updates on NDTV Profit.